Oil is a vital commodity for the global economy, and its price is influenced by many factors, including supply and demand, geopolitics, and market sentiment. One of the most important factors affecting oil supply is the political stability and security of the major oil-producing countries, especially in the Middle East and North Africa (MENA) region, which accounts for about 40% of global oil production. In this section, we will examine how political instability and violence in four major oil-producing countries in the MENA region, Libya, Algeria, Iran, and Iraq, can disrupt oil supply and increase oil prices globally. Libya is one of Africa's largest oil producers, with proven reserves of about 48 billion barrels. However, since the 2011 uprising that toppled Muammar Gaddafi, the country has been plagued by civil war, political fragmentation, and militia violence. These conflicts have severely damaged Libya's oil infrastructure and disrupted its oil exports, which are the main source of income for the country. For example, in January 2020, a blockade by forces loyal to General Khalifa Haftar shut down most of Libya's oil fields and ports, reducing its output from 1.2 million barrels per day, (BPD), to less than 100,000 BPD. This caused a loss of about $6 billion in revenue for the country and contributed to a global oil price spike of about 4%. Algeria is another major oil producer in Africa, with proven reserves of about 12 billion barrels. The country has been relatively stable compared to its neighbors, but it has also faced social unrest and political uncertainty in recent years. In 2019, mass protests forced President Abdelaziz Bouteflika to resign after 20 years in power, and a new constitution was approved in 2020 that aimed to reduce the influence of the military and the ruling elite. However, the opposition and civil society groups have criticized the reforms as insufficient and called for more democratic changes. Algeria's oil sector has also suffered from underinvestment, corruption, and inefficiency, resulting in declining production and exports. Algeria's oil output fell from 1.7 million BPD in 2010 to 1.2 million BPD in 2020, and its oil revenue dropped by 40% in 2020 due to low oil prices and the COVID-19 pandemic. Iran is one of the world's largest oil producers, with proven reserves of about 157 billion barrels. However, Iran's oil industry has been severely affected by U.S. sanctions that were reimposed in 2018 after the U.S. withdrew from the 2015 nuclear deal. The sanctions have targeted Iran's oil exports, banking sector, and other key industries, causing significant economic hardship and social discontent in the country. Iran's oil exports fell from about 2.5 million BPD in 2018 to less than 500,000 BPD in 2020, and its oil revenue declined by more than 80% in the same period. The sanctions have also limited Iran's access to technology and investment to maintain and expand its oil production capacity. Moreover, Iran faces regional tensions and security threats from its rivals such as Saudi Arabia, Israel, and the U.S., which could escalate into military conflicts that could disrupt its oil supply and the stability of the region. Iraq is another major oil producer in the Middle East, with proven reserves of about 145 billion barrels. Iraq has been recovering from decades of war, sanctions, and violence that have damaged its oil infrastructure and hindered its development. Since 2003, Iraq has increased its oil production from about 1.3 million BPD to about 4.4 million BPD in 2020, becoming OPEC's second-largest producer after Saudi Arabia. Iraq's oil sector accounts for more than 90% of its government revenue and more than two-thirds of its GDP. However, Iraq still faces many challenges that could jeopardize its oil supply and growth prospects. These include political instability, corruption, social unrest, fiscal crisis, infrastructure bottlenecks, environmental degradation, and security threats from terrorist groups such as ISIS and militias backed by Iran. Iraq also has to comply with OPEC's production cuts to support global oil prices amid weak demand due to the COVID-19 pandemic. In conclusion, political instability and violence in major oil-producing countries like Libya, Algeria, Iran, and Iraq can disrupt oil supply and increase oil prices globally by reducing their output, exports, revenue, and capacity, and by creating uncertainty, risk, and volatility in the global oil market. These disruptions can have significant implications for the global economy, energy security, and geopolitical stability. Oil transit routes are the pathways that oil and gas take from their source countries to their destination markets. These routes often cross regions that are prone to geopolitical tensions and conflicts, such as the Middle East and North Africa. In this section, we will explore how three of these routes, the Suez Canal, the Strait of Hormuz, and the Bab el-Mandeb, are vulnerable to disruptions and how their closure or disruption can affect global oil trade and markets. The Suez Canal is a man-made waterway that connects the Mediterranean Sea with the Red Sea. It is one of the most important oil transit routes in the world, as it allows ships to avoid sailing around Africa and save time and fuel costs. According to Reuters, about 15% of global shipping traffic moves through the canal, including oil and gas. The canal can accommodate tankers carrying up to 200,000 deadweight tons (DWT) of crude oil or 165,000 cubic meters of liquefied natural gas (LNG). The canal also has a parallel pipeline system called SUMD, which transports about 80% of the oil shipped from the Middle East Gulf to Europe, according to the SUMD website. The pipeline has a capacity of about 2.8 million barrels per day, BPD. The Suez Canal is vulnerable to disruptions due to its narrow width and depth, which can cause accidents or blockages by large vessels. For example, in March 2021, a giant container ship called Ever Given ran aground in the canal and blocked it for 6 days, causing a massive backlog of ships and affecting global trade. The canal is also vulnerable to security threats, such as attacks by militants or pirates, or political instability in Egypt or neighboring countries. The closure or disruption of the Suez Canal can have significant impacts on global oil trade and markets. According to the International Energy Agency, IA, between December 2020 and February 2021, about 3.6 million BPD of oil moved through the canal, of which 1.5 million BPD was crude. More crude flows eastwards from Europe and North Africa to Asia than westwards from the Middle East Gulf to Europe. About 1.1 million BPD went east during this period, accounting for about 4.5% of Asia's seaborne imports. About 400,000 BPD went west, mainly to Europe. The closure or disruption of the canal can cause delays or diversions of oil shipments, affecting supply and demand balances and prices in different regions. It can also increase transportation costs and risks for shippers and buyers. The Strait of Hormuz is a narrow waterway that connects the Persian Gulf with the Gulf of Oman and the Arabian Sea. It is the most important oil transit channel in the world, with some 15.5 million BPD of crude oil passing through in 2019, according to the U.S. Energy Information Administration (EIA). This represents about a third of all seaborne oil trade and about 20% of global oil consumption. The strait can accommodate tankers carrying up to 300,000 DWT of crude oil or 260,000 cubic meters of LNG. The Strait of Hormuz is vulnerable to disruptions due to its strategic location and geopolitical significance. The strait is bordered by Iran on the north and Oman and the United Arab Emirates on the south. Iran has repeatedly threatened to close or disrupt the strait in response to sanctions or military actions by its rivals, such as the United States or Saudi Arabia. The strait is also vulnerable to attacks by militants or pirates, or accidents or collisions by vessels. The closure or disruption of the Strait of Hormuz can have severe impacts on global oil trade and markets. According to Reuters, if Iran were to block the strait completely, it could cut off about 17 million BPD of crude oil from global markets, equivalent to about 18% of global consumption. This could cause a spike in oil prices and a shortage in supply for countries that depend on imports from the Persian Gulf region, such as China, India, Japan, South Korea, and Europe. It could also affect Iran's own oil exports and revenues, as well as those of its neighbors. The Bab el-Mandeb is a choke point between the Red Sea and the Gulf of Aden that connects the Suez Canal with the Indian Ocean. It is another important oil transit route that transports Persian Gulf oil exclusively. According to Weebly.com, many times, the oil that Persian Gulf and Middle Eastern countries export gets mixed with other countries' oil in other routes, which makes the Bab el-Mandeb unique. The strait can accommodate tankers carrying up to 200,000 DWT of crude oil or 140,000 cubic meters of LNG. The Bab el-Mandeb is vulnerable to disruptions due to its proximity to conflict zones and security threats. The strait is bordered by Yemen on the north and Djibouti and Eritrea on the south. Yemen has been embroiled in a civil war since 2014 that has drawn in regional powers such as Saudi Arabia and Iran. The Houthi rebels who control parts of Yemen have launched attacks on ships passing through the strait using missiles or drones. The strait is also vulnerable to attacks by pirates or terrorists operating from Somalia or other nearby countries. The closure or disruption of the Bab el-Mandeb can have significant impacts on global oil trade and markets. According to EIA.gov, about 6 to 8%, or 22 million tons, of global LNG trade passed through the strait in 2020. About 25% of Middle East LNG exports transited the waterway to deliver gas mainly for European buyers. The closure or disruption of the strait can cause delays or diversions of oil and gas shipments, affecting supply and demand balances and prices in different regions. It can also increase transportation costs and risks for shippers and buyers. The global economy and oil markets are recovering from the historic collapse in demand caused by the coronavirus pandemic, and the staggering inventory surplus that built up last year is being worked off, and global oil stocks, excluding strategic reserves, will return to pre-pandemic levels. And however, oil demand has shifted lower as a result of rapid changes in behavior and a stronger drive by governments towards a low-carbon future. This raises the prospect of a peak in oil demand sooner than expected if policies and technologies accelerate the transition to clean energy. Even before the unrest in the Middle East, oil demand was growing steadily as the world economy rebounded from the pandemic-induced recession. According to the International Energy Agency, IEA, global oil demand will climb by 2.2 million barrels per day, MB/D, this year, reaching 96.7 million barrels per day. This is mainly driven by strong growth in China, which saw an all-time record demand of 14.8 million barrels per day in March 2021, as its recovery continues to surpass expectations. Other emerging markets, such as India, Brazil, and Indonesia, are also contributing to higher oil consumption as they recover from the pandemic and expand their industrial and transport sectors. The rising demand for oil has put upward pressure on prices, which have more than doubled since their lows in April. The Brent crude oil benchmark averaged $64 per barrel in March 2021, up from $30 per barrel a year earlier. Higher oil prices reflect not only the improving demand outlook, but also the supply discipline exercised by the Organization of the Petroleum Exporting Countries and its allies, OPEC+, which have agreed to cut production by about 7 million barrels per day compared to pre-pandemic levels. The IEA estimates that global oil supply will increase by only 1.4 million barrels per day this year, reaching 97.5 million barrels per day, leaving the market in a slight deficit. Higher oil prices have significant implications for inflation, growth, and trade balances in different regions and countries. In general, higher oil prices tend to boost inflation by increasing the cost of energy and other goods and services that depend on oil as an input. This can erode consumers' purchasing power and reduce real incomes, especially for low-income households that spend a larger share of their income on energy. Higher oil prices can also affect economic growth by reducing disposable income and consumption, as well as investment and production in energy-intensive sectors. The impact of higher oil prices on inflation and growth varies depending on the degree of dependence on oil imports or exports, the pass-through of oil prices to domestic energy prices, and the monetary and fiscal policy responses of governments and central banks. For example, higher oil prices tend to benefit oil exporting countries by increasing their export revenues and improving their fiscal and external balances. However, they can also create challenges for economic diversification and fiscal sustainability if they lead to excessive spending or borrowing based on volatile oil revenues. On the other hand, higher oil prices tend to hurt oil importing countries by increasing their import bills and worsening their trade deficits. However, they can also create opportunities for energy efficiency and renewable energy investments that can reduce their dependence on oil imports and enhance their energy security and environmental performance. Moreover, some oil importing countries may benefit from higher oil prices if they are net exporters of other commodities that are positively correlated with oil prices, such as metals or agricultural products. The IEA projects that higher oil prices will increase global inflation by about 0.3 percentage points this year compared to a scenario with constant oil prices at $40 per barrel. However, this effect will vary across regions and countries depending on their exposure to oil markets and their policy responses. For example, inflation is expected to increase by more than 1 percentage point in India and South Africa due to their high dependence on oil imports and limited pass-through of lower domestic fuel prices during the pandemic. In contrast, inflation is expected to increase by less than 0.2 percentage points in China and Japan due to their lower dependence on oil imports and higher pass-through of lower domestic fuel prices during the pandemic. The IEA also projects that higher oil prices will reduce global growth by about 0.2 percentage points this year compared to a scenario with constant oil prices at $40 per barrel. However, this effect will also vary across regions and countries depending on their exposure to oil markets and their policy responses. For example, growth is expected to decrease by more than 0.5 percentage points in India and South Africa due to their high dependence on oil imports and limited fiscal space to cushion the impact of higher energy costs. In contrast, growth is expected to increase by more than 0.2 percentage points in Russia and Saudi Arabia due to their high dependence on oil exports and improved fiscal positions from higher oil revenues. In conclusion, the global economic recovery and rising demand from emerging markets have contributed to higher oil prices even before the unrest in the Middle East, which could add further volatility and uncertainty to the market. Higher oil prices can affect inflation, growth, and trade balances in different regions and countries depending on their exposure to oil markets and their policy responses. Higher oil prices can also create challenges and opportunities for energy transition as they affect the relative competitiveness of different energy sources and technologies.